Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. As the S&P 500 has rallied 16% off its low, many people arguing that this is just another bear market rally and that this looks awfully similar to what happened right here in July of 2008 as we got this brief bounce before the eventual collapse of the market. And I can quickly show you this chart right here that I've seen a lot on social media that highlights the similarity between what was happening in 2008 and what is happening now. You can see right here, it is a pretty similar look, a similar type of topping pattern, a similar bear market rally here, a similar bounce that we're seeing right now before the big collapse. A lot of very famous investors are currently anticipating. So today I want to talk about something very specific. I want to talk about home builders and their ability to time the market, to predict the market. We've had famous investors throughout history like Stanley Druckenmiller that has famously used home builders to predict market moves throughout his career, both to the downside and to the upside. So I'm going to show you how this works and whether or not we're in a similar situation to something we had throughout 2008 leading up to that big drop. By the way, if you are interested in following these crazy markets with us, don't forget to click on that subscribe button. We make these videos multiple times a week looking at what's happening across the financial markets and the type of opportunities that we can find. Without further ado, let's get right into it. So the way we see the market is like a machine where all the pieces are fitting together. Each component has an influence on the next. And home builders is one of those components, right? And you can see, for example, in 2018, it was remarkable at timing the bottom of the 2018 bear market right here, where you saw home builders basically anticipate the bottom leading up to that capitulation low. And likewise, as the market was topping, you can see here home builders were moving down very aggressively. Right there, giving you a warning signal leading up to that top. You can see same thing right here at the COVID top, right there before the big crash. You can see the home builders' relative performance was making a lower high relative to the market that was continuing on higher. And I can continue showing you great examples of that. For example, right here in March, this is a great one where the market was moving higher, bouncing very aggressively. Look at what home builders were doing. XHB was collapsing here. So if you had seen that signal on the 1st of April, right at the top of this rally, and you would have used home builders as a leading indicator of market performance, well, you would have sidestepped this entire drawdown and potentially re-entered right here as home builders were making a higher low while the market was making a lower low. Outperformance of home builders telling you the market is potentially getting ahead of itself on the downside. So this is a great way of showing you how the financial market machine works and how sometimes you can also get markets that see things wrong, right? The market was wrong here. Home builders were right about collapsing here ahead of time. By the way, don't forget to smash that like button if you're so far enjoying this episode. It really is appreciated. It makes the effort that we put into making these videos, these presentations, it makes it worthwhile. Now, another great example of how we view the market as really a machine where you have all of these pieces fit together and everything makes sense is when we took a look at oil towards the end of August and discussed how overvalued that commodity was. And you can see if you compare oil to 5-year inflation break-evens, so this is expectations of inflation from the bond market, you can see they trade very closely to one another. But often you have oil that basically overshoots expectations, right? So inflation expectations of the bond market are a lot more reasonable, they're a lot less volatile, but oil shoots up, it shoots down, up, down. And so sometimes you get this undervaluation or overvaluation on oil that you can take advantage of. And in the middle of 2022, you can see here big overvaluation on oil. Whether you compare that to the inflation break-evens or PMIs, right? You can see PMIs, this is basically economic growth right? Manufacturing PMIs, this red line is basically the economic cycle going up and down over time, and oil follows that very closely. So this is another example of that machine working, all the assets being correlated and following that cycle. But you can see oil gets undervalued sometimes, it gets overvalued at other points. You can see here 2008, this was probably the most profitable trade of the last 20 years, is shorting oil right before the global financial crisis, when oil was trading at $150, when PMIs were going negative. That was a big dislocation in the market, and look at what happened to oil following that move, right? Massive move down. By the way, we will be doing a Black Friday discount for the membership on gameoftrades.net. So if you are interested in that, make sure to sign up to our newsletter and you'll be notified as soon as we release the offer, so you make sure you don't miss it. Getting back on topic to the subject of the video, you can see here, if we look at what home builders are doing today, they're outperforming, right? They're moving higher, just like they were in 2018. This is the market telling me home builders are not being very pessimistic right now. Or not as pessimistic, at least, as they were in the first quarter of 2022. This was home builders flashing a major warning signal. Now you don't have that pessimism nearly as much as you did in that first quarter of 2022. Now, of course, the counter argument is that this is just another repeat of this pattern right here that we saw on this ratio between home builders and the S&P 500, and that we are seeing that right now with this just being a consolidation pattern before the next move down in home builder. And you can see that would of course be devastating. If I put the S&P 500 on top of this chart, you can see this pattern occurred as the market was heading to the top of the stock market towards the end of 2007. But of course that hasn't happened yet. Could it happen? Of course it could, and we'll take that as an objective information if that does happen. But for now, that's not the case. For now, home builders are outperforming, and in fact this is a rate sensitive sector. So if you put the inverse of the 10-year yield, again speaking to how the financial market machine works, you can see there's a tremendous relationship between home builders and the 10-year yield. As yields rise, so they fall on this chart, home builders underperform. As they reverse, well, home builders outperform. And of course we have an optimistic view on yields moving down, so home builders could actually accelerate to the upside here. That's something that's entirely possible, in which case that would be a good leading indicator of the stock market outperforming once again. But of course that's not always true, right? The machine works, but it's not perfect. You can see, for example, throughout this period right here, home builders were underperforming significantly leading up to the big top in 2007, right? December 2007, I believe, that was the top of the market. And you can see throughout this entire move, yields were telling you that home builders should be outperforming when really they were underperforming. So that was a big warning signal of the bond market that was telling you, hey, the economy is weakening, the housing market is collapsing, even though equity investors are expecting a collapse of the housing market here, even though rates are being favorable to the economy and rates are coming down. Again, this is the inverse of the 10-year yield. So yields were falling throughout this period. That should have been good for home builders, but it wasn't. If you start to see this type of move where yields are falling, so they're rising on this chart, and you see a collapse of home builders, that looks a lot like 2007, right? So this is something we'll have to watch out for, something we're closely looking at as a warning signal, because we know it's been very efficient in the past. And if we see that type of breakdown, we'll be taking the necessary precautions on the model portfolio we have at gameoftrades.net. A breakdown could look like, hypothetically, you see this type of pattern right there. If we get this type of development as bond yields are falling, the Fed is easing, this is telling you, all right, you want to be getting out of the market even though the Fed is getting dovish, even though monetary policy is easing, because the housing market is weakening too much, and that's a leading indicator of the economy and potentially earnings deteriorating in the near future. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash that like button and click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.